Hello and welcome. There's a fresh contender in the mid-cap space as Bank of India Mutual Fund is rolling out its mid-cap fund. Joining us now is Alok Singh, Chief Investment Officer at Bank of India Mutual Fund. And he'll walk us through the strategy and where he sees real opportunity in the mid-cap segment. So stick around till the end. We'll cover how this fund plans to stand out, manage risk, and whether it deserves a spot in your portfolio. Welcome, Alok.
Thank you. Thank you for inviting me.
Good to have you here. Let's begin with the big picture. There are already so many mid-cap funds out there. So what makes your strategy different? And do you apply a specific lens or filter when picking funds?
Well said. Yes, there are many mid-cap funds, some of them having long and great track record. But having said that, if you look at what makes this space interesting and why we are looking at it, that this space, which used to be very narrow, if you look at in terms of number of stock as it is 150, but then also there was only few things doing okay, right? And then everyone chasing that. This space is now actually having a very high churn, what we see, and it will increase. Why I'm saying so is because if you look at the economy at large, right, as it is becoming bigger, and the entire startup ecosystem, and all these plus one and plus twos and FTAs, that is leading to lot of new pools of profits getting generated, and many of them forms part of the listed space, right? As a result, we are seeing many companies coming into the universe of mid cap faster than they used to be earlier, right? And that what means is that it becomes very high research oriented space. And then if we apply our framework to that, I think we have been demonstrating a decent amount of alpha generation capabilities in that space. And I think we feel confident that we will be able to do justice with this fund as well. So, the change in the churn in the space is what one is very, very high. And I think overlaying that with our capabilities, I think will make us do better. And that's why, while we may be one of many coming to mid-cap space, but I think we have a decent right to win because of these two things, and we should be able to do justice with this strategy.
Right, but can you elaborate on what makes your strategy different? Do you apply a specific lens or filter when picking stocks for this fund?
So the way we are looking at it at our space is one is, of course, the basic hygiene factors which everyone looks at it. The important part for us is one is the the eye on what is that we want to achieve from this business, and which is well reflected by the ROEs of the business, right? So either you should be buying good businesses at decent ROEs, right, which everyone tries to, or the second is that what will make the ROEs look better tomorrow, right? And you get a hand on that, right? That, okay, these things are changing. Today, it may be a depressed ROE business, but, if these things play out, it may reach to its ROE, which is a healthy ROE. I think these two things are what we are trying to do. And that will, you can say that if you have to submit in one line that, okay, what are you looking at in terms of uniqueness? We are looking at, buying a good ROE companies at reasonable price, or buying low ROEs companies with some hypothesis or work to say that, okay, this can change to this, and hence it will help you generate alpha. I think that is one part of our framework, which we are very confident. And obviously, what I've said is just one line. It takes a lot of work and research and bottoms up work to reach that stage to say so, right? But yes, I think that is what we are focusing on to generate alpha in this particular fund.
All right. So mid caps, they come with big opportunities and there are big swings there in this segment. So how do you plan to balance the upside potential of this segment with the volatility risks that often concerns investors?
So yes, volatility has been high, and it will remain high, right? Because if you look at mid cap, if you look at any individual human being's life cycle, right? So first 20-25 years of your life, you are very vulnerable, and then balance 25-30 years is the most productive form of your life, and then you mature and you become stable. Now, if you look this from the if you look this from the point of view of a company's life cycle, it is very similar, right? The initial, which we call the small cap category, it is when they are most vulnerable, single client, or non-predictable cash flows, lower margin, and then comes the mid cap phase where the margins improve, the cash flows improve, the client base get more diverse, and they become stable. And that's what we call the high growth phase. And then the markets start get attracted towards it, and we start then giving growth multiples to them. And the moment we start giving growth multiples, obviously it is the future which we are discounting, and that leads to a lot of misses and the calculation errors, and that's what induce a lot of volatility. I think that will continue to be there. The right way to do it, and what we have been doing is basically do the allocation sizing right. So the risk management. So if you are taking a risk in terms of buying something which is more vulnerable, then you have to manage it or match it with the risk management, right? So in risk management and investment, one of the big factor is the right allocation, how much to buy, how to scale up. And I think that's a science and an art, which is a combination, which is what need to be practiced as part of your fund management process, which help in managing that volatility over medium to long term.
Right now, let's dig a little deeper into the portfolio construction. So, will this be a focused, high conviction portfolio or a broader, diversified one? How many stocks do you expect to hold on average?
So, as we know that the mid cap is which is synonym to high growth companies, right? And when you are in the high growth phase, there will always be hits and misses. And it is only on the hindsight that you can establish whether the decision was right or wrong. That means that you have to have a right, as I said earlier, a right allocation. In that, we believe that somewhere around 50-55 stocks strategy works better. But yes, to have the right alpha generation in the portfolio, we intend to run at least top 20 allocations to be at least 50% of the portfolio. So it's well concentrated, but at the same time not too concentrated, and gives us scope to manage risk with slightly longer tail. And also gives scope for scaling up and scaling down your position over a period of time in the non-disruptive manner. So I think that's what we intend to do here.
All right. So, like you mentioned, mid cap is synonymous to high growth companies, and it is a space which is known for creating 100 baggers, but also for hype. So, how do you identify true wealth creators without falling for that survivorship bias?
Interesting question. I think that's a dilemma and the challenge which every fund manager go through. I think, and everyone has their own ways and means to address this. The way we like to look at it, that if you have identified a stock, first thing is you need to identify uh, which stage of, or which, every company has a life cycle, right? So which stage of its life cycle it is, right? Because that will determine your allocations over there. And then when you say that, okay, this is in the early stage, basically you will make multi-baggers if you get into the early stage of it. Now, in the early stage, obviously, the risk and the rewards are both on the higher side. So there where your allocation strategy and how you scale up your position over the period of time. One way of doing it is that, okay, you say that this particular thing based on your understanding and hypothesis can be, say, 5, 7, 8% of your portfolio. And you just straight away go and buy 8%. And then obviously, if it does not fares well against your hypothesis, obviously there is this disappointment. Other way is that you scale up slowly. So let your hypothesis get validated. So if we say that, okay, this is a company which is making, say, 10% EBITDA margin, and as the operating efficiency sinks in and the company becomes bigger, this 10% EBITDA margin can become, say, 15, 18% EBITDA margin, right? So obviously it is not going to happen in one quarter. So there you will see a decent progress or steps towards moving towards what you are thinking and possible for that business to do. I think then if you scale up as your hypothesis is getting validated, most of the time people confuse hypothesis validation with the stock price performance, right? Which is not right. Hypothesis is not validated by the stock price performance. Hypothesis get validated when what you think will lead to the price change is getting confirmed by the financial performance of the company, right? And as it does, then you scale up, because if you are looking at a multi-bagger, right, typically it is not 10, 20, 50% or 100%, it will be much more. So I think you should be ready to let go some of those front-ended returns for the sake of getting validated that what you are thinking is actually possible and happening. And I think that helps in lot of this biases to go away, survivorship to be tested whether it is not. And if your hypothesis is wrong, you will be able to validate it, or you will be able to identify it much earlier with much lower allocation. And I think that's the way, because you will have accidents, you will have wrong thing, but the art is that are you able to identify it in right time and take corrective action?
All right. Okay. So we've seen mid-cap rallies in the past driven by liquidity or narrow themes. So how do you stay disciplined during such phases and avoid chasing momentum?
So if I answer this in continuation to the previous question, right? Whenever the multi-baggers are generated, basically if you look at the multi-bagger goes through all the three phases of life cycle, which is being a value company to a growth company to a momentum, right? Only when these three phases get played out, it becomes a multi-bagger. Otherwise, it is a doubler or at best that kind of a thing, which is whether you're looking at the last phase of momentum or the middle phase of growth or the early phase of value, right? Obviously, when you are looking at only the last phase, right, it becomes most risky. So the middle part, which is the growth phase, is the most secure, because either the company will slip back to a value company or will become a momentum company. But if you are looking at the momentum, if you get it on the last stage, obviously it can be the last point of the cliff, and that's where the accidents happen. So frankly speaking, while everyone chase momentum, and that's one of the things which is easier to look at it, but I think it is the most difficult thing to identify and staying away from it, right? Typically, last few rallies, people have made a lot of money from that, but that was coming from the macro environment which we were, right? And the reset of the economy which we had seen for last 3-4 years. But I think in the normalized market, to have entire market and momentum, I think is very, very difficult. So will the momentum, the way the mid caps or momentum, will that continue? I don't think so. I think it is increasingly becoming a very, very bottoms up market, and it will continue to be the case till we are operating in a normalized market, unless there's some disruption happening. So I'm not that worried about it. Yes, only few stocks do well and everyone looks to concentrate, and because in mid cap there are only 150 stocks, so you have to be concentrating on that. I think that risk is universal, right? Until this definition does not undergo a change, there is very little you can do. I would put it like as a hazard of investing in mid cap. I hope that the list is longer, but till it is not there, I think it is not something which we can do anything about it. Lastly, what I see is also, what is happening is that I believe that, we last decade, we saw a lot of companies getting consolidated. So what we struggled was a good company become a part of a large company and, become a conglomerate. As a result, the investable universe was getting reduced. Now, if you look at there is a sense in the promoters or the large shareholders that the demerge or the uniquely identified businesses creates more value, right? As a result, there is a clear trend of demergers happening and newer good businesses getting independently listed, right? And second is the entire startup ecosystem and all that, right? So I believe that, earlier what we saw, that 150 stock list was quite stable, right? But I think our view is that going forward, because of these two reasons, the churn over there will be higher, and hence it will help active fund managers to play an important role in generating the alpha from these two things.
All right. So finally, one last question, and one that most investors would be looking for. Who is this fund for? Should it be a part of a core portfolio, or is it better suited as a satellite allocation? If you could throw some light on that.
So mid cap as a category is a core portfolio, right? So it has to be part of the core portfolio. And anybody and everybody who is investing in equities should see mid cap to be part of its portfolio. Obviously, the percentage allocation changes depending on the risk profile and various other factors, but it has to be there. And anything which you are looking to be a core portfolio, there are two important things which are needed. One, that the core portfolio allocation should be true to label, right? And second is it should be efficient, because only then is when your portfolio gets the impact of it. Otherwise, there are slippages, right? Which is not good from the wealth creation point of view. So yes, it is a core strategy. I think one should look at it. And we are, our promise to the investors is that we will, manage it with focus to, maintain it as true to label, as well as efficiently as we can do, and we have been doing all other funds.
Right. And what kind of investor is it more suited for? Conservative, aggressive, or?
See, if that's not a right way, right question, so to say, because if 100% of my allocation is coming to mid cap, obviously, then it is an aggressive fund and it has a volatility. But if I am looking at sum of parts, which is, I'm constructing a portfolio where you have some allocation towards large cap, some towards mid cap, and some towards small cap. And I think then in that case, obviously, this is slightly high volatile product. So, and that's the nature of it. And so are the return profiles. So I think it is to be part of core. Whether it forms 10% or 80%, it is something which each individual has to do the assessment to figure out what's the risk profile and what should they be running.
All right. Well, with that, time for us to wrap up this conversation. Thank you for joining in and answering our questions.
Thank you very much. Thank you.
Thank you. Well, that was Alok Singh with an inside look at the Bank of India Mid Cap Fund. And if you're considering mid caps, remember these funds reward patience, but they demand a strong stomach. We'll keep bringing you sharp insights to help you invest better. Thanks for watching. See you in the next one.